Hey, and welcome back. If you've ever sat down and Googled something like, is it a good time to buy a house at 11 p.m.? You're not alone. That's literally one of the most searched real estate questions there is, year after year. And today I'm going through the 10 real estate questions people search for online more than almost anything else. And I'm going to give you the real, straight answers, not the vague, it depends, non-answers that you usually get. And by the end of this video, you're going to know more than most people walking into their first home purchase. Quick housekeeping. If this is helpful, subscribe. I put out videos like this regularly to help you navigate buying and selling without the confusion. So let's get into it. Question number 1. Is it a good time to buy a house? This is consistently the number one most searched real estate question. And I get it. Nobody wants to buy at the wrong time. But here's the honest answer. There's no universal good time. There's a good time for you. Now, the market is always good for somebody and bad for somebody else at the exact same moment. If the rates are higher, then that's often better for negotiating on price. If the rates are lower, then more buyers show up and you've got more competition. If the inventory is tight, sellers have leverage. And if the inventory is loose, the buyers do. It's a seesaw. It never sits still, and waiting for the perfect condition of low rates, low price, and low competition is waiting for something that basically never happens all at once. So instead of asking, is it a good time in the market? Ask these questions instead. Do I have stable income that I expect to continue? Do I have a down payment and closing costs saved, or a clear plan to get there? Am I planning to stay for at least a few years? Does owning make sense for my life right now? Not just financially, but practically. If the answer to those is yes, it's a good time for you, regardless of what's happening nationally. If the answer is no, no amount of perfect market conditions is going to fix that. Real estate is personal before it's about time in the market. One more thing, you can always refinance a rate later. You cannot renegotiate the years you spent renting and building someone else's equity instead of your own. Marry the house, date the rate. Question number 2. How much house can I afford? And this is where a lot of people get tripped up because there's actually 2 different numbers here and they're often not the same. So number 1, what a lender will approve you for. This is based on your income, your debt, your credit, and down payment. Lenders typically look at your debt-to-income ratio, how much of your gross monthly income is going towards debts like the car payments, student loans, credit cards, plus your projected new housing payment. Most conventional guidelines want your total debt load, including the new mortgage, to lay under roughly 43 to 50% of your gross monthly income, though this varies by loan program and lender. Number 2. What are you actually comfortable spending? And this is the one people skip, and it's a more important one. Just because a lender approves you for a certain amount doesn't mean that that's the payment that actually fits your lifestyle. I always tell buyers, get pre-approved first so you know your ceiling. Then sit down and figure out your real comfortable number separately, factoring in savings goals, other expenses, and how much cushion you want. Here's a practical way to think about it. Take your pre-approval number and then ask yourself, if I max this out, what am I giving up? Is it vacations, retirement contributions, a cushion for emergencies? If the answer makes you uneasy, shop below your max. There's no one rule that says you have to spend every dollar that you're approved for. Also, remember your monthly payment is more than just principal and interest. You've got property taxes, homeowner's insurance, potentially mortgage insurance. And if it's a condo or an HOA, dues on top of that. Ask your agent or your lender to break down the full estimated payment, not just the principal and interest, before you fall in love with a number. So what credit score do I need to buy a house? And people assume that you need an excellent credit score to buy a house, and you don't. But the score absolutely affects your options and your interest rate. And here's the general breakdown by loan type. So a conventional loan typically wants a minimum credit score in the 620 range, though better rates usually kick in around the 740 and up. FHA loans are more forgiving, often down to 580, and sometimes lower with a bigger down payment. VA loans for eligible veterans and service members don't have a government set minimum, though individual lenders often set their own floors. USDA loans for eligible rural properties typically want scores in the 640 range, depending on the lender. Now, here's what actually matters more than memorizing numbers. Your score determines your interest rate tier, and even a modest difference in rate can mean a real difference in monthly payments over the life of the loan. So if your score isn't where you want it yet, it's often worth pausing for a few months to build it up before you buy. Pay down the credit card balances. Don't open new lines of credit right before applying, and don't miss any payments. And here's a myth I hear constantly. Checking my credit will hurt my score. A soft pull, like the kind many pre-qualification tools use, won't hurt you. A hard pull from an actual mortgage application might drag your score a few points temporarily, but shopping multiple lenders within a short window, usually 17 to 45 days, depending on the scoring model, typically counts as a single inquiry, not several. Don't let fear of checking stop you from getting the real numbers. Question number 4. How much is my home worth? This is the number one search for anyone even loosely thinking about selling. And there are a few ways to answer it, some more accurate than others. So you have automated valuation tools. That's the instant estimate you get from the big real estate websites, and they're a starting point, nothing more. They're built off algorithms and public data, and they don't know that you renovated the kitchen, that the roof is brand new, or that your street backs up to a busy road. Treat them as a rough ballpark and not the gospel. Now, a comparative market analysis, or a CMA, is done by an agent and is far more accurate. And this involves pulling actual recent sales of comparable houses in your area that are similar size, condition, age, and location, and adjusting for the differences between your home and those. This is the same type of analysis appraisers use just for the agent side, and it accounts for things an algorithm can't see. An appraisal is the most formal version, typically ordered during an actual transaction by a lender, done by a licensed neutral third party. If you're just curious, a CMA from a local agent, which most agents, myself included, offer for free with no obligation, is going to give you far more realistic numbers than any online estimate. And your home's value isn't just about the square footage. It's about the condition, the updates, the location specifics, and what buyers in your market are actually willing to pay right now for what you have. Question number 5, buyer's market versus seller's market. What's the difference? So you'll hear these terms thrown around constantly. So here's what they actually mean, and more importantly, what they mean for you. So a seller's market happens when there are more buyers than available homes. Now, demand outpaces supply. So homes sell faster, often with multiple offers, and sellers have more negotiating leverage. They're less likely to make concessions on the price or the repair. Now, a buyer's market is the opposite. There's more homes available than the buyers actively searching. The homes sit longer. Buyers have more room to negotiate on price, the closing cost, or repairs, and sellers are more motivated to make deals happen. Now, here's the part most people miss. Markets aren't just one size fits all, even within the same city. You can have a seller's market for starter homes and a buyer's market for luxury properties in the very same zip code at the very same time, because different price points and property types have different pools of buyers. So instead of asking, is it a buyer's or seller's market as a blanket question, ask your agent what the market looks like for specifically the types of homes, the price range, and the area that you care about. The number is far more useful than a national headline. Question number 6, how much do I need for a down payment? The 20% number gets thrown around so much that people think it's a requirement. It's not. It's actually a threshold that helps you avoid private mortgage insurance on a conventional loan. But plenty of loan programs let you put down far less. So, for instance, a conventional loan can go as low as 3% for qualified first-time buyers in many cases. FHA loans typically require a minimum of 3.5% down. VA loans for eligible veterans and service members can allow 0% down. USDA loans for eligible rural properties can also allow 0% down. And there's a lot of programs, especially like here in Tennessee, we have the THDA program that helps with down payment assistance. Now, the trade-off of putting down less than 20% on a conventional loan is usually private mortgage insurance. And that's an added monthly cost that protects the lender, not you. But it typically drops off once you build enough equity. Now, on a side note, some lenders will not automatically notify you when this happens. So keep up with it, and when you reach that point, call them and verify. On FHA loans, the mortgage insurance rules work a bit differently, but they're worth reviewing with your lender. Beyond the down payment itself, don't forget the closing costs. Typically, a percentage of the purchase price covers things like lender fees, title work, prepaid items like taxes and insurance. Ask your lender for a full breakdown early so there are no surprises. The real question isn't what's the minimum I can put down, it's what down payment gets me to the monthly payment and the loan terms I'm actually comfortable with. Sometimes putting down more makes sense. Sometimes it makes more sense to put down less and keep cash in reserve. That's a conversation to have with your lender based on your full financial picture. Question number 7. What is earnest money and do I get it back? So earnest money is a deposit or good faith money that you put down when you go under contract on a home, showing a seller that you're serious. And it's typically held by a neutral third party, often a title company or escrow agent, and applied towards your down payment or closing costs at closing. Now, here's the part everyone actually wants to know. Do I get it back if the deal falls through? Well, there are 2 answers. So usually yes, if you're within your contingencies. So most contracts include contingencies for inspection, financing, appraisal that let you back out and get your earnest money returned if things do not go as planned within a specific time frame. For example, if the home inspection turns up a major issue and you back out during the inspection period, you typically get your deposit back. So the second part of that is usually no if you back out for a reason outside of your contingencies or after the contingency deadlines have passed. If you just get cold feet with no contract protected reason, the seller might be entitled to keep it. This is exactly why it matters to have an agent walk you through your contract specific contingency deadlines before you sign, and why you should never let those deadlines slide without checking in. The dollar amount of earnest money also varies. It's often a small percentage of the purchase price, but it's negotiable and can depend on your local market terms. Here in the Upper Cumberland Plateau area of Tennessee, we typically do 1%. Question number 8. How long does it take to buy a house? Well, from the moment you start looking to the moment you get the keys, most home purchases take somewhere between 30 and 60 days once you're under contract. But the full journey, including the search itself, varies a lot person to person. So here's a rough breakdown. Getting pre-approved, that can often happen the same day, if not a few days, and once you have all your documents in order. House hunting. This is the most variable part. Anywhere from a few weeks to several months. It really depends on your criteria, the inventory available, and how decisive you are. Under contract closing, typically 30 to 45 days for finance purchases, sometimes less for cash. It really depends on the title company, but this covers your inspection period, the appraisal, and the final loan underwriting. So the fastest way to speed up things on your end is have your financial documents organized and ready before you start looking. Know your must-haves versus your nice-to-haves so you can move quickly on the right home, and stay responsive to your agent and lender during the process. Slow responses are one of the biggest causes of delays that are actually in your control. Question 9. What is a home inspection contingency? So a home inspection contingency is a clause in your purchase contract that gives you a set window of time, around 5 to 10 days, though it varies by contract and local practice, to have the home professionally inspected, and based on what's found, negotiate repairs, ask for credit, or in many cases, just walk away from the deal entirely with your earnest money protected. This is one of the most important protections a buyer has, And it's a big reason inspections matter. Even when a home looks perfect on the subsurface, inspectors check things you can't see on a walkthrough: the condition of the roof, the HVAC system, electrical, plumbing, foundation, and more. Just think of it as a white glove inspection of the home. Now, once your inspector gives you the report, you generally have a few paths. You can ask the seller to make the repairs. You can ask for a credit towards the closing costs instead, or you can accept the home as is if the issues are minor, or you can walk away if something major turned up that changes the deal for you. Now, what you can't do is wait past your contingency deadline and expect full protection. So this is a timeline worth tracking closely with your agent. Question number 10. How do I choose a real estate agent? And this one's personal for me to talk about, so I'll try to keep it practical. A few things actually matter more than others. So local market knowledge, someone who knows your specific area, not just the real estate in general. Number 2, I'd say, is communication style. Do they respond quickly? Do they explain things clearly? Or do you feel like you're chasing them down? Number 3, I'd say, is how they handle the tough conversations. Will they tell you the truth about a home's flaws or just tell you what you want to hear? And number 4, I'd say, is experience with specific situations, whether that be first-time home buyers, investors, relocation, whatever your circumstance is. And a quick way to vet this is to talk to more than one agent before committing and ask how they'd handle a specific scenario, like finding out a home that you love has a major inspection issue. Their answer tells you a lot about how they'll actually operate when it matters. So that's the 10 of the most searched real estate questions out there. Answered straight, no fluff. If you found this helpful or useful, subscribe and drop a comment with any questions that you've Googled that I didn't cover here. I read every one, and it might turn out to be its own video. But thanks for watching, and I'll see you in the next one.